Debt to income ratio, or DTI. What is it and why is it so important? Well, DTI, or debt to income ratio, is a calculation that we do as your lender to help us determine whether or not this loan you're trying to get and this new monthly mortgage payment is really something you can afford. Here's how we calculate it. We take your total monthly liabilities, things like your student loans, your credit card debt, your auto loans, and plus that proposed monthly mortgage payment. So we add all those together, and that becomes the top figure in this calculation. And then the bottom figure is your total gross monthly income. Now remember, gross monthly income is the income before anything comes out of your paycheck. All right? So we divide those two figures and we come up with a ratio. Now, if that ratio is 45% or lower, there's a good chance you're going to qualify for your loan. If it goes above 40%, 45%, it makes it a lot more difficult. Why is that number so important? Like I mentioned earlier, it gives us an idea whether or not you can really afford this new mortgage payment. Think about all the other payments you have to make each month, and now you're adding on a mortgage payment, which for most of us is the largest payment we're going to have each month. Okay, for you as a borrower now, as a homeowner, it's an important figure for you to consider as well, because if that ratio is too high, it's going to tell you something. It's going to tell you that maybe this new mortgage payment that you're taking on is perhaps not quite within your budget. So it's something to really consider, and hopefully it's a conversation you have with your loan officer. All right, my name is Greg Kisiel. I'm a senior loan officer, and this was your Mortgage Minute.